Radixas, welcome to our Financial Facts channel. We Radixas will give you some valuable tips and tricks on how you can make yourself financially independent regardless of what you earn now and where you live now. How does a stock price change? We will discuss about why and how stock price changes every day. Because one day stock price is up by 3% and on next day down by 2%. Let us see what is the reason behind the stock price movement. There are two major market forces which causes a price action. They are supply and demand. If supply is more, then the demand goes low. If supply is less, then the demand goes high, which means low demand will lower the price, high demand will higher the price. For an instance, let's assume a well-known software company, Accenture, makes a deal with Toyota Car Company for managing their software development and maintenance for $300 million. This will increase the Accenture revenue, so many people will be interested to buy stock since Accenture making good progress. And the demand for the Accenture will go high, no one will be ready to sell the stock which is low in supply. This high demand and low supply leads to increased sale price of Accenture stock. Those who already have Accenture stock, if they want to sell during the high demand, they can sell it for high price. There are some other major influencers who also drives the stock prices, such as institutional investors and speculators. The institutional investors are like investment bank, mutual funds, pension funds, etc., who involves in the market price movements. And finally, the speculator. The speculators are mostly individuals buy and sell stock and try to outperform long-term investors by taking high risk. Speculator will attempt to anticipate price movements in order to profit. Many traders and investors fit into this category. Let us see some of the important difference between speculator and investor. Speculator takes high risk to try to get high return, whereas investor takes below average risk and seek to generate a satisfactory return on their capital. Speculating is almost like gambling. Most of them will gamble without fundamental company analysis, whereas investor will do all fundamental analysis on the company before investing on them. Most of the speculator will do high frequency of trading, whereas investor will keep buying the stock for long term. They will not think about short term profit. Speculator takes high risk by trying to compete with institution and automatic artificial intelligence robot trading, whereas investor never need to worry much about short term traders and focus only on the company overall growth. Thank you for listening. Make sure to like and subscribe.